How to read an income statement like a Wall Street analyst. Most people think reading an income statement requires a finance degree. It doesn't. What if I told you that 3 numbers, just 3, can tell you whether a company is actually making money or just faking it? And right now, millions of investors are missing this, losing thousands in their Roth IRAs and 401 kiloseconds because they don't understand what they're looking at. Today, we're breaking down the income statement so thoroughly that you'll never miss a red flag again. Let's start with what you're actually looking at. An income statement is basically a company's report card for a specific period, usually 3 months or a full year. It shows you exactly how much money came in, how much went out, and what was left over. That's it. Everything else on that document is just the breakdown of those 3 things. Think of it like your personal bank account. Money comes in from your job. Money goes out for rent, food, and your Robinhood subscription. What's left is what you actually made that month. Apple's income statement works the exact same way, except instead of thousands, we're talking billions. Part 1. The top line. Revenue. Here's where every income statement starts. Revenue. This is the total money the company brought in before any expenses. When Tesla reports $24 billion in revenue in a quarter, that's every single dollar they made from selling cars, charging stations, and software. This is what Wall Street analysts obsess over first. Why? Because revenue growth tells you if a company is actually expanding or just surviving. But here's the trap most beginners fall into. They think higher revenue always equals success. Wrong. A company can make $100 billion and still be losing money. I'll show you why in a second. The key thing to track with revenue is the growth rate. If a company grew revenue 15% year over year, that's one story. If they only grew 3%, that's a completely different story. That's the difference between a company crushing it and a company that's starting to slow down. This matters for your portfolio because slow growth companies often underperform in the market. Part 2. The middle. Operating expenses and the magic number. Now watch this closely because this is where amateur investors and Wall Street analysts split apart. After revenue, you subtract all the expenses. Cost of goods sold. That's what it actually costs to make the product. Then operating expenses, salaries, rent, marketing, research. Subtract all of these from revenue and you get something called operating income. This is the magic number. Operating income tells you whether the core business actually works. Not the accounting tricks. Not the one-time gains. Just pure business performance. If a company has massive revenue but tiny operating income, you're looking at a business with serious problems. Amazon did this for years. Remember, huge revenue, break-even operating income. Investors didn't care because they believed in the vision. But most companies that do this eventually fail. The operating margin, that's operating income divided by revenue, tells you how efficient a company is. Apple's operating margin hovers around 30%. That means for every $100 they make, $30 is actual profit. That's incredible. Most companies are between 5 and 15%. If you're looking at a company with less than 3% operating margin, they're probably struggling. Part 3. The bottom line. Net income. After operating income, you subtract taxes and interest. What's left is net income. This is the actual profit that belongs to shareholders. This is the number that matters most for your portfolio if you're holding stocks in your Roth IRA or 401k. It's also the number that gets manipulated most. A company can write off a building sale or a one-time gain and suddenly look more profitable than they actually are. This is why Wall Street analysts look deeper. They calculate something called adjusted net income, which removes one-time items to show the real, recurring profit. You should do the same. Look at net income, but then read the notes section and ask, Is there anything weird buried in here? The pro move, and this is what separates analysts from regular investors, is comparing all three numbers year over year. If revenue is up 20% but operating income only grew 5%, the company is losing efficiency. That's a sell signal. If both are growing together, you're probably looking at a strong business. Closing. Now you know what Wall Street sees when they open an income statement. Revenue, operating income, net income. Track the growth rates. Watch the margins. You're no longer a passive investor hoping for the best, you're informed. You'll spot problems before the market does, which means better returns in your portfolio. If this helped you, subscribe. We're breaking down balance sheets next week. And trust me, that's where the real secrets hide.